Bets on when the Federal Reserve's going to raise US interest rates are starting to look like the playground game involving the petals on a daisy. This year, next year, sometime, never. Plunge in markets prompted by fear about the prospects for China is widely seen as a reason for the Fed to delay once again in September. Futures prices now suggest a higher chance that the Fed stays on hold to the end of the year as well. This line shows the likelihood of the Fed doing nothing in September using a basic model from Bloomberg. There are other methods of calculation which adjust for various factors, come up with different figures, but the pattern they come up with is always the same. And it shows a much greater chance now of the Fed doing nothing. Now, markets this year have really quite drastically reassessed the prospects. Back in January, seen as almost certain that rates would be rising next month, or at least they would have risen by the time that meeting happens. Even 4 weeks ago, the chance of a rise was better than 50-50. That is, there was less than 50% chance of them doing nothing. That chance of them doing nothing has now risen above 70%, very slightly down today, but basically 1 in 3 chance of them actually hiking, as the Fed's expected to use market weakness as an excuse to do nothing. Now, this makes some sense based on history. The red bars on here show the size of falls in US shares of more than 10% over 10 days. The latest fall there, just before today's rally took off, is just slightly more than 10%. Now, it should be obvious that share price falls have tended to coincide with lower rates. Now, sometimes the causation is absolutely clear, as when the Fed immediately cut rates after Black Monday in October 1987. That's the drop in the blue line there, the Fed policy rate, Fed funds rate, after this really quite horrific fall that we saw on Black Monday. A similar thing happened in September 1998, month after Russia's default. Other times, though, the Fed's tried to wait. It did in 1974, when the market plunged in August, but the Fed then waited until November to resume its rate cuts, or in 2002, when the market fell heavily in July, the Fed waited until November before easing again. Now, sometimes the causation's trickier. For example, both the Fed and the markets reacted to the failure of Lehman or to September the 11th. The Lehman failure is this bunch of falls in the markets and obviously, hit this drastic cut in interest rates. And September the 11th is this big fall here, and I think that drop there. 2011 we had something similar when the Fed started Operation Twist amid a slowing economy. Looks like rates, of course, stayed on the floor because they couldn't be cut any further, but after that big drop and slowing GDP, the Fed started a sort of QE 2.5. Now, Goldman Sachs economists have rounded up a whole bunch of different research on the impact on the Fed of equity price moves over recent decades. And while they come in with a big range, overall the economists concluded that a 10% drop in the market pushes the Fed to have rates 15 basis points lower than they otherwise would be. If we put that another way, this reduces the chance of a quarter-point rise in September by 60%. Now, Bill Dudley, head of the New York Fed, today told investors exactly what they wanted to hear when he said that the case for a rate rise was now less compelling than it had been. Well, he did also say that it was important that the central bank shouldn't overreact to short-term market swings. Now, while the tumble in shares might give policymakers pause, there are still good reasons for them to raise rates. So far, at least, the US economy remains reasonably robust, despite of all the problems that are going on in emerging markets. There's little sign of inflation, but even with growth relatively low by historical standards, spare capacity in the US economy is clearly being used up fast. Indeed, Mr. Dudley himself noted that local employers in New York are complaining about a lack of available skilled workers. Now, the best guide to what the Fed's likely to do will probably come on Saturday, when Fed Vice Chairman Stanley Fischer will speak at the central banker's summer getaway in Jackson Hole. What he says about the impact of the emerging market and China turmoil on the US economy will matter a lot, as well as what he says about the risk of deflationary second-round effects hitting the US after the lower oil and metals prices have their initial impact on consumer prices. But for the doves at the Fed, the drop in the market provides the perfect excuse not to raise rates. Ironically, that's likely to be good for share prices.